All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our midweek options update. What I want to do here with today's session is walk you through where we stand on some of the key markets that we track, specifically the index ETFs. I'll walk you through what we've seen to start the week, what we're expecting here for the end of the week. Also take a look at two new trades that we are looking at here for the next week or so, trades that are setting up yet today. And then finally, we'll take a look at some of our overnight pop trades that we closed out this morning. These are trades that we put on just yesterday afternoon. So let's go ahead and dive in. As always, if you have any questions at any point during the session today, feel free to post those at any point in time. If you're watching the recordings on YouTube or in Facebook, feel free to post a comment on those videos and I will get back with you as soon as possible. And you can always email me directly as well, mike@netpicks.com. So let me go ahead and turn my camera off. All right, so make sure that you guys can see my charts, and I'll try to make them as big as possible so you guys can see the levels that I'm talking through. All right, so like we normally do, let's start out with a daily chart of SPY. I like to look at this chart every day because it helps form context around the overall market. I'm not looking to base my trading decisions off of this chart, but it is a chart that I use a lot to determine how aggressive or conservative I want to be. So far this week, we actually saw futures Sunday night when they opened up Sunday evening. We saw a pretty nasty move to the downside. We saw some pretty nasty selling into Monday morning. As soon as the opening bell rang Monday morning, it's been off to the races ever since. And you can see from Friday's low last week down around the 368 level, we've rallied all the way up to 383. The high of the session today is just over 383. That's a heck of a move for SPY. We are extended in the near term. We're very overbought in the near term. What does that mean for the rest of the week? Doesn't mean we can't head higher from here, but I do think it's going to be more difficult to maintain this pace to the upside. Here's why. First of all, look at the volume picture down at the bottom. Here we are going into the end of the session. Here we've got another, oh gosh, what is it, 1:30 now? So we've got another 2.5 hours in this session, but we've only had 25 million shares trade so far today. That's a very light number compared to what we have been seeing over the past week or so on the downside. Those moves to the downside that we saw recently, we are well above 100 million shares on a daily basis. So the volume continues to be very light on the upside, very typical of a tired market. Areas of resistance to keep an eye on here. Should we continue this run to the upside? The all-time high at 385.85, that's going to be a level that we're going to want to watch closely. If we don't see a pickup in volume, I think it's going to be very difficult to get up through and break that all-time high. So look for some pretty strong resistance should we get up to that level. On the downside, the same moving averages that we've been talking about now for months remain in place on the downside as support levels. We have the two green lines. Those are the 20-period simple and exponential moving averages. Then you've got the solid pink line there. That is the 8-period exponential moving average. We, at the very minimum, we need to break those levels on the downside if we're going to get anything going lower. Notice where we found support last week, right on top of the 50-period moving averages, both the simple and the exponential. We found support right there, and as has been the case now for the last 10 months, anytime that we test these moving averages, it's just a springboard back up to the highs. We're seeing that yet again here this week. What I am expecting here, going into the end of this week, into next week, I do think we will start to see things slow down on the upside. I do think we'll start to see some pullback. I'm not saying that we're going to completely fall apart. I'm not expecting that at all, especially given that, now there's additional talks of more stimulus. We don't know what it's going to look like yet. But the catalysts just aren't there as of yet for a significant move lower. A healthy pullback into these moving averages would be a welcome sight. That would reset things potentially for another wave to the upside. Notice what's happening down at the bottom with the ATR. The average true range has also started to roll over here. We've seen a nice spike from around 4 up to around, right around 5.5 or so. That really came due to the move to the downside last week. But now here we are this week, and things are definitely starting to slow down, and we're starting to see that ATR roll back over. We do not want to see that happen. What we're seeing here today with volume light, with markets tired, as range contracts, it's going to be more difficult as active traders to find those attractive setups. I want to see activity remain elevated. I want to see that ATR flip back to the upside. If that's going to happen, we're most likely going to need some selling pressure. So it's something that we'll want to watch here over the next couple of days as well. The VIX did briefly last week get up above 30. We are down back around 23, just under 23 and a half here today. It's still a good number historically, but we have certainly seen volatility contract over the last couple of days. So we've seen the VIX move from over 30 down to around 23. So we've certainly seen some volatility contraction. If we can't get any type of significant selling here over the next week or so, I would expect the VIX to very quickly get down into the teens. Wouldn't be surprised if that happens at all. How does that shape what we do here? Why am I pointing out all of these levels in the daily chart and the VIX and ATR? Because it shapes what types of trades I'm looking for. I'm not opposed to buying long calls and long puts. Just some things to keep in mind. Number one, in a lot of cases right now, the options are expensive. Volatility is still elevated historically. It's in a better environment for selling premium here with volatility high. Okay. I'm also trading a fair number of monthly options. If I'm going to trade the weeklies here, I'm going to do so exclusively through the credit spreads. So we'll talk about that more in just a brief moment. Now let's talk about how we've been trading here this week, specifically with our overnight pop trades. Going into yesterday's close, the last hour of the session is when we like to look at SPY, looking for the overnight pop trades going into options expiration. SPY does have the Wednesday expiration cycle. I get a lot of questions on that, Mike. Why are you trading expiration midweek? It is one of the few products out there that does have multiple expirations that we can work with. So what we did, go over to the trade page here a second. We'll talk about a couple of these trades. We actually put on two different trades here overnight, yesterday afternoon, going into the close, expiration, going into the close today. So let's talk about the call credit spread that we put on first. So what we did, the nice part about expiration is we know that time decay is extreme, as is the gamma. And for those of you that are newer to trading options, the gamma is a term that refers to how quickly the options change for every dollar change in the price of the stock. It basically tells you how reactive the options are going to be. When you get this close to expiration, the options become very, very sensitive to any type of price movement in the stock. The options are very sensitive to time decay as well. And we're looking to take advantage of that by selling credit spreads into expiration. And what we did, because the market was overbought, we came in and we took a look at selling an out of the money call spread. Specifically, we sold the 384, 386 call spread. All that means is I am selling the 384 call and I am buying the 386 call at the same time. It gives me a fully risk-defined trade. We put this trade on yesterday and we collected 63 cents or $63 per spread. It tied up around $137 of our capital per spread. So you can put this trade on with 10 spreads and still have less than $1,400 of risk. It's a very reasonable trade as far as cost goes. Here's why I love this position. The market was overbought yesterday afternoon. I didn't want to just come in and blindly buy a long put, because if I buy a long put, the only way I make money on that trade is if SPY makes a decent move to the downside. I wasn't necessarily expecting that. By selling a call spread like this, now I give myself 5 ways of making money. I don't care if SPY moves up, down, or sideways. It does not matter as long as price stays below the strike price of the option that I sold. In this case, the 384 strike. Okay, so coming into the session today, the open on SPY was around 382.5. I had about $1.50 cushion where I could be dead wrong and SPY could move to the upside and I was still okay. I could still make money on the position. Fortunately for us, after the open, we actually saw a move down to around 380.5. That move to the downside allowed us to close out of the position within the first hour of the session and booked a nice profit. So we made money if SPY moved up, down, or sideways, as long as price stayed below 384. We made money from the significant time decay that was present because we're so close to expiration. And we could have made money if volatility decreased as well. That was the fifth way that we had of making money on the position. We ended up closing out of the trade. We sent out an alert here this morning. We closed it out for 16 cents. Okay, so we bought it back for 16 cents. I get questions on this quite a bit. Why wouldn't we just hold all the way into expiration? Why wouldn't we just hold to the end of the day? The problem with that, in this market, we have seen just about every dip has been bought up almost immediately, right? We've seen very little follow through on the downside. What I didn't want to have happen is hold the trade into this afternoon, have the market bounce like it has, and have that trade go from a nice profit to a loss. It's very possible because, again, we're so close to expiration. The gamma risk is elevated. The options are very sensitive to changes in stock price. I would rather book the profit as soon as I can, ring the register, and free up the capital for the next round of setups. We booked a $47 profit per spread. You hear that and you're saying $47. I mean, it's hardly a game changer. Well, keep in mind, we only tied up $137 of our capital to begin with. So it's very possible for a lot of retail accounts to be able to take this with multiple spreads. Again, taking it with 10 spreads, you still have less than $1,400 of risk. Now, all of a sudden, you've got $470 of profit overnight. Pretty attractive, right? Put on a couple of these trades a week. It's a nice little supplemental income, potentially even replacing an income over time. I'd love this type of a trade. It just gives me more diversification. Anytime that I can book a 30% return on my capital overnight, I will take that every single time, especially considering we had a high probability of success on this trade. We had 5 ways of making money on the position. It's a very forgiving trade. So really nice trade. Had you held, if you're still holding the position, it's still profitable. It's now trading for 20 cents. The key there is just to watch this one closely to make sure that price stays below 384. Right now it's trading for around 383.30. So you got about a 70-cent cushion here. If you still have the trade, the SPY could continue to move higher and you're still okay on the position. But we are currently flat. We booked the profit earlier today. Now, the second trade that we put on, the first one that we talked about, selling the call spread, is a neutral to bearish position. We ideally wanted SPY to move to the downside. And fortunately for us, that's what happened first thing this morning. The second trade that we put on is known as an iron condor. And all it means, I know the name is funky, and a lot of times people get intimidated by the name. All it means is I'm selling a call spread and selling a put spread at the same time. Instead of picking a directional move on SPY, this is a neutral trade where I'm looking for SPY to stay inside of a defined range. Here's how it works. What I did in the February 3rd options, the ones that are expiring today, we put it on yesterday afternoon. We sold the 385, 387 call spread, and then we sold the 377, 375 put spread at the same time. All that means, on the call side, I'm selling the 385 call, and I'm buying the 387 call at the same time. And then on the put side, I'm selling the 377 put, and I'm buying the 375 put at the same time. I'm trading 4 options at the same time. It creates what we call our profit window. The profit window is defined by the options that we're selling. So my profit window was defined by 385 on the upside and 377 on the put side. I didn't care if SPY moved up, down, or sideways. It did not matter to me as long as price stayed in between those two levels. I could make money. Okay, now people a lot of times ask, okay, if the stock goes straight sideways, if it doesn't move, how do we make money? We're betting on the time decay adding up. We know that this close to expiration, these options are going to lose value very, very quickly. If price stays quiet, they're going to suck a lot of the premium out of the options. That's a big enemy of a trader that's long an option. But as a credit spread trader, we're able to put that time decay in our favor. We put this trade on yesterday afternoon. During the last 30 minutes of the session, we collected 60 cents or $60 per spread. It tied up $140 of our capital. That was the most we could lose in the trade. If we were dead wrong, the most I was out was $140 per spread. Again, we made money if the stock moved up, down, or sideways. As long as it stayed between 385 and 377, I was okay. We made money from time decay adding up and from volatility decreasing. Well, what has happened today? We've actually had some pretty decent movement back and forth. But in the grand scheme of things, we haven't seen that runaway move in one direction. We've seen some back and forth. We've seen some chop, but that's all we needed here. We ended up closing out of this position. Or first thing this morning, within the first half hour of the session, we closed it out for 17 cents. Okay, so we bought it back for 17 cents. It's actually now, if I open up the price here, it's actually now trading for 4 cents. So there's actually a little bit more profit potential out of the trade, but we wanted to book the profit while we had it this morning. Again, free up the capital, and I have to watch it closely throughout the rest of the day. So it gave us a $43 profit per spread. So you put it on one time, yeah, you've got $43 of profit overnight. You put it on 10 times, right? You put it on 10 times, you got $1,400 at risk. Now all of a sudden you've got $430 of profit. Okay, so you take those two trades there. Let's just say you took both of those trades with 10 spreads. Okay, you've got about just under $3,000 of risk if you take that approach. So you're using up $3,000 of your capital, and you've got just under $900 of profit overnight. Okay, we are into these trades around 3:30 Eastern time yesterday afternoon. We're out of these trades during the first hour of the session today. These are the quick overnight pop trades that complement some of our other longer term positions really well. For me, I love these trades because it allows me to generate some consistent income throughout the week while I'm holding on to some of those other positions for a longer stretch of time. I might be in some longer term positions for 2, 3, 4 weeks. And if I'm in those positions for 3 weeks at a time, I'm not necessarily booking any profit along the way. I'm not bringing the register on those trades. The overnight pop trades allow me to generate some income while I'm holding some of those other positions for a longer stretch. That's why I love taking these trades. SPY, I do look for these trades. SPY has Monday, Wednesday, and Friday expirations every week. Most other stocks and ETFs will have weekly options. Most of the ones that we trade, at least. So you're going to have the opportunity to take these types of trades every Thursday afternoon into Friday on a whole wide range of products. So you've got an opportunity to be active with these types of trades every week. All right, let me transition over. Let's talk about some new trades that are setting up for us for the next couple of days. I've reviewed where our thinking is big picture going into the end of the week, market wide. We've talked about some trades that we closed out here this morning, but let's talk about some potential new candidates for us going into next week. Let's start out with the silver ETF. This is SLV. It's definitely been in the headlines. Potentially as the next target from the Reddit traders, the traders that are starting to get out of GameStop and AMC, and now they're talking about making a run at silver. Well, based on that news, Monday morning, we saw a pretty significant gap to the upside. Okay, you can see it was pretty significant. It was impressive. It didn't last long, and yesterday it sold right back off. Once we saw that sell-off back into some support levels, we came down and tested our red and blue line there. That's the 8-period EMA. Once we tested that level, that had me interested in initiating a new long position. Our trend strength histogram down at the bottom, it's the red and the blue histogram, was in bullish mode. It turned blue. So now we've got bullish momentum taking over. Price is above our white and yellow line. That's the 50 EMA. Price is also trying to move back up above the 8 EMA. So we've got a lot of factors lining up for another run to the upside. What I'm looking at doing, let's go over to the trade page on silver. We are going to utilize the March monthly options. Those are the options that have 44 days left to expiration. Let me shrink some of this stuff down so it's easier to see. So we're looking at the March monthly options, and we decided to come in and take a look at the 24 calls. I highlighted that line there in blue. They have 44 days left to expiration. They get us a couple strikes in the money. The delta is at 0.62. All of that meets our criteria for a long call or long put. These options are currently trading just over $2. You're talking about $200 of capital required to put this trade on. It is a bullish position. I only have one way of making money on this trade. SLV has to move to the upside, and it's got to do so relatively quickly. If it takes too long or if the move's not big enough, that's going to hurt the position. I don't mind putting on a bullish trade here with long calls because it matches my outlook. It matches what I'm seeing over on the charts. So this is one way of putting on a straight bullish trade. There's plenty of volume, plenty of open interest. It's a very liquid product, very tight markets. The bid-ask spread there is only 2 cents wide. So you shouldn't have any problem getting filled on that trade. So where is our target? Where's our stop? On the upside, anytime that I initiate a long call or long put, my initial target is to double my money. I'm looking for 100% return. My risk, if you want to use a defined stop, we recommend using a 50% stop. So if you get filled, let's just call it at $2.04. You would put a stop in at $1.02. Okay, so the whole goal, I mean, we're not guaranteed to hit 100% profit. I mean, there's definitely times I get out with a 40, 50% return. Just depends on what the market does over the next couple of days, next couple of weeks. But ideally, what we're looking for on long term, we want to give ourselves a chance to get a positive reward to risk ratio long term. That's ideally what we're looking for. All right, so that is the first trade that I wanted to highlight on SLV. And then the second trade, let's talk about Microsoft here, symbol MSFT. It's been super strong over the last couple of weeks, really going back to earnings. And just today, you can see that we got another series of green bars on our pulse histogram down at the bottom. What does that indicate? When I see green pulse bars there, it represents price hitting between a 2 and a 3 standard deviation channel move. In other words, we're overbought. It doesn't mean price can't move higher from here. It just means that it's not statistically probable. Price is tired. Okay. It doesn't mean that we're going to try to pick the top here, but chances are over the next couple of days, the next couple of weeks, we're probably going to start seeing at the very minimum, some consolidation, potentially some sideways movement. I want to put on a neutral to bearish trade that would benefit from that sideways move, or even better, a reversal to the downside. So what we did on Microsoft, go back over to the trade page here. We're going to take a look at utilizing another credit spread. Now, a little bit different from the other trades that we just got done talking about. This is not going to be an overnight pop trade. This is going to be a trade that I'm looking to hold for a couple of weeks. And what we did is we utilized the March monthly options. So we stayed with the options with 44 days left. And we took a look at selling the 250, 255 call spread. Now, we actually got filled on this trade yesterday afternoon. We actually got filled around $1.50. So we collected $150 per spread. So let me just change the price here so you can see what we did yesterday. So getting filled at $1.50, we collected $150 per spread. That's my maximum profit potential. My maximum risk on this trade is $350. That's the most I can lose on the trade. Okay, if I am dead wrong and Microsoft continues to grind its way higher, the most I'm out is $350. I have 5 ways of making money on the position. I make money if Microsoft moves up, down, or sideways. As long as price stays below 250, I'm okay. The only move that hurts me is a big move above 250, which I'm not expecting because price is already so overbought. We also make money from time decay adding up and from volatility decreasing. So if we get any type of a pullback, any type of selling over the next few weeks, it's going to allow us to make money faster. We just don't need it. If we do nothing but sit straight sideways here over the next few weeks, we can make money there from the time decay adding up. So again, this is another trade, just like we talked about in the overnight pop trades, they're very forgiving. The long call position on SLV, that's an aggressive directional trade. I need a big directional move in my favor. This type of a trade is going to tie up less capital when compared to just buying an outright call or put on Microsoft. It's going to give me 5 ways of making money. And it allows me to make money from that dreaded sideways move that can kick in. Now, how do we manage the position? My target zone on anytime that I'm using a credit spread, my target zone is always between 50 and 75% of my max profit. My max profit is whatever I collect to put the trade on. In this case, $1.50. If I can buy this spread back for between 37 and 75 cents, that would allow me to keep between 50 and 75% of the max profit. I can create that closing order here today. Create that closing order for 37 cents. That way, if any time over the next couple of weeks, if we do get a sell-off, if we can get that spread trading for 37 cents, that trade will be executed and we'll go ahead and close out of the position. Right? So that is the Microsoft call credit spread that we put on. I continue, when I see these overbought markets, I continue to lean towards using the credit spreads for a couple of reasons. Number one, these sell-offs that we've had have been very news-driven. They've been very short-lived. I mean, every dip that we've had here for really going back to March of last year, every dip has been bought up pretty quickly. You haven't had very much follow-through. The moves to the downside are swift, and a lot of times they're not very deep. A lot of times we just get more consolidation than anything. By selling those call spreads, it still allows me to benefit from a move to the downside in a more conservative way. If we start to get more follow through, if we can start to get some of the selling continue into day 3, 4, 5, that can certainly change the ballgame. That would certainly pique my interest for more long puts, but we just haven't had much of that. So I'm going to continue to look for a lot of credit spreads and just to take advantage of some of the higher volatility that we have right now. I mean, with the VIX above 20, there's some decent juice in these options. The options, some of you have seen this because I get emails on it on a daily basis right now. When you've got Apple, Amazon, Facebook, Tesla, Google, all of these big tech names, a lot of these names market-wide are very expensive. They've had incredible moves to the upside, up towards the all-time highs. As a result, the options are very expensive. By using the credit spreads, you're going to drastically reduce the cost of the trade. I mean, Microsoft, we're talking about $350 of capital required for a neutral to bearish position. If I come in and just buy an in-the-money put here, you're talking about over $1,300 just to buy an individual put. The credit spread ties up far less capital, gives me less risk, still a defined risk trade. I know what my maximum loss is right up front before I ever put on the trade. That's why I love these types of positions. So we are open to a mix of different trade types. Like we talked about today, we'll use some credit spreads. We'll use some long calls and long puts. The key there is to diversify as much as possible over time. All right. So if you have any questions on anything that we've covered here today, the trades that we closed out this morning, or any of these new trades that we're talking about here right now, feel free to type those questions in. I will be back on Friday as we wrap up the week. We'll come back for our weekly recap. At that point in time, we'll have some additional overnight pop trades to talk through. We'll also take a look at some potential new trades for next week. If you'd like more detail on the overnight pop trades that we've been talking about in these sessions, I'd love to connect and give you some additional information. My email is mike@netpicks.com. Feel free to email anytime. So I don't see any questions coming through, so I'm going to wrap it up here for today. Enjoy the rest of your day, everybody, and hope to see you back here on Friday for our weekly recap. We'll talk to you then.